Good morning, traders, and welcome to BCI's morning market analysis. First up, let's have a look at the US dollar. The DXY remained around 98 into the end of last week, sitting at its lowest level since early October, as markets continue to price into Federal Reserve rate cuts in 2026, despite strong US GDP data earlier this week. Rising geopolitical tensions lifted safe haven demand for precious metals, adding further pressure on the dollar. So far, the dollar has fallen 9.7%, marking its weakest annual performance since 2017. The decline reflects increasingly dovish monetary policy expectations and widening policy divergence, with the Bank of Japan expected to raise rates by 25 basis points, the ECB likely to hold, and the US rate expectations continuing to narrow interest rate differentials. From a technical perspective, the dollar index remains in a bearish structure after breaking below the 98 level. Short-term moving averages are sloping lower. RSI is at 36.84 and MACD remains below the zero line, signaling sustained downside momentum. With year-end liquidity thinning, the index may remain range-bound between 97 and 98.42 in the near term. Next up, let's have a look at WTI. Crude oil traded in thin holiday conditions last week, closing slightly higher at around 56.83 per barrel, which is up 0.53% on the week. Despite modest gains, market fundamentals remain firmly dominated by oversupply, with the IEA forecasting global supply to exceed demand by 3.84 million barrels per day in 2026. Geopolitical developments also provided short-term support, but have not really altered the broader supply-demand imbalance. Oil markets continue to face mixed signals, with potential supply disruptions on one hand and weak demand growth alongside elevated inventories on the other side. The possibility of progress towards peace talks between Russia and Ukraine also remains a key factor, as any easing of sanctions could further increase global supply of crude oil. From a technical perspective, WTI rebounded from 54.88 in mid-December and briefly reached 58.67 before consolidating below $58 amid low liquidity. Prices remained below key medium-term moving averages, keeping the broader trend bearish, while RSI has recovered to around 50, which suggests that there is temporary easing of downside momentum rather than a trend reversal. Next up, let's have a look at gold. Gold surged to a fresh record high of 45.50 last week, driven by strong safe haven demand and escalating geopolitical risks and continued expectation of US rate cuts. Markets remain focused on tensions surrounding Venezuela, Russia, Ukraine, and the recent US military actions in Nigeria. Gold is now up over 70% year to date, marking its largest annual gain since 1979. The rally has been underpinned by a combination of central bank buying and ETF inflows, with emerging market central banks continuing to increase gold reserves. Countries such as China and Japan, where gold holdings remain relatively low, are seen as having further allocation potential. Technically, gold remains in a strong long-term uptrend despite short-term overbought conditions. Prices broke above the previous high of 43.81, surged to 45.31 on Christmas Day, and then pulled back towards 44.80. And that's people taking their year-end profits. Moving averages remain bullish. MACD shows strong upward momentum, and while RSI peaked at 81.3, the current consolidation appears to be a healthy pause rather than a reversal. Key support remains around the $4,400 level. Lastly, let's have a look at the Australian dollar, which climbed to around 67.24, which is its highest level since October last year, supported by expectations that the RBA could tighten policy if inflation remains elevated. RBA meeting minutes highlighted a focus on the upcoming Q4 CPI release on the 28th of January, with markets currently pricing in a 28% probability of a 25 basis point rate hike. While policy is expected to remain unchanged in 2026, 2026. The risk of tightening continues to support the Australian dollar. It was also boosted by strong commodity prices, with gold and copper hitting record highs and brought by broad US dollar weakness. Against the Japanese yen, the Australian dollar reached a 17-month high and is up nearly 7% this quarter. Technically, the Australian dollar remains in a strong bullish structure, having broken above 67 cents and reached a 14-month high last week. Short-term moving averages remain positively aligned. RSI sits at 69.73 without entering overbought territory, and MACD remains above the zero line, confirming ongoing upward momentum. Well, that's all for today's morning market analysis. As always, manage your risk and happy trading.